computer. All right, go ahead, Annette. Tanette.
All right, I'm back again and I'm super excited. It's that time of year that some people dread unless you have an excellent tax professional to help you get a great refund. And I'd like to introduce you to that type of person. Her name is Cassandra, and I'm gonna let her explain a little bit about herself and her experience.
Hello, Tonette and everyone else. My name is Cassandra Johnson, and I am an accountant. I have been in business now for 17 years. So I do have a tax business. I don't just do taxes, I actually do taxes, bookkeeping, payroll, and I really like to talk about financial planning. I'm not a financial advisor, but I do work very closely with several financial advisors so that I and we can help guide, business owners, and not even if you're not a business owner, but taxpayers in the direction of how to keep as much money as we can in our own pockets and not basically be giving it to the government. So I'm all year round. I am located in Chesapeake, Virginia, but I service all states. So I have them everywhere pretty much. A lot of things that I do can be remote. Do have clients mail in their information. And I do have a lot of them that would actually come down to sit with me and visit. So that's pretty much me in a nutshell. Would love to help in any kind of way that I can.
Excellent, excellent. So let's get started. That's actually how I met Cassandra, was through my financial advisor, David. And she's definitely been very accessible and willing to answer questions. And that's why I think that she's, I'm so excited to interview. And we're just gonna go ahead and get started. The first thing that—
And I'm all year round, just so everybody know. I'm not just during
all
tax
year round. Okay.
So I don't
Yes.
shut down after tax season, only just to breathe for a couple of days and then I'm right back at it. But I am all year round. So great to know. Yes.
So I think our first question is related to business filing deadlines in terms of taxes. Are they the same? Are they different?
So they're actually different. So let's start off with what most people will actually file, or how most people set up their businesses. So a lot of people like to set up, the first thing they kind of know about is an LLC. And that's one of the main things before they kind of dig into really knowing exactly what kind of business they want to set up. An LLC is what most people set up. So when you set up with an LLC, that's really the structure of the business. Now, when you get ready to file for your EIN number, that's how the Internal Revenue looks at you from a filing standpoint in terms of how you file your taxes. So an LLC can be set up and filed in two different methods, which one is a Schedule C. A Schedule C is actually a part of your personal tax return. And that is also called a sole proprietorship. The other way that an LLC can be filed from the Internal Revenue standpoint is through a partnership, which is a 1065. And that's considered a pass-through entity, which means you have a business and you have income, you have expenses, and whatever the bottom line is, that will then pass through to a K1, which is then passed through to your personal return. That business actually allows you to, one, not pay into self-employment taxes. So that eliminates that from can be a pretty hefty side if you are a sole proprietor. Then you have the self-employment taxes from that standpoint. Partnership is exactly what it is. Normally it's two or more partners who uses a partnership. And a pass-through entity is very good, especially if you have, especially in a real estate business. So in a lot of times in a real estate game, you guys have your own maybe full-time jobs, things like that. A pass-through entity will allow any losses that occur to be able to be used Otherwise, if you have rental properties and investment properties on your actual tax return, which goes on a Schedule E, if your income, your adjusted gross income is above that $150,000 threshold, you won't be able to use the losses. The losses just kind of sit there and they carry over. A pass-through entity allows you to be able to use those losses. So I'm going to kind of go back. I'm going to go off, I guess, in terms of now, in terms of your dates. I will get there. Then we have something also called the S corporation. An S corporation is also a pass-through entity, and that's considered a single member corporation. So your Schedule Cs are actually due when your personal tax return is due, which is April the 15th. You have your pass-through entity, which is a 1065, and your single member corporation, which is an S Corp. Those are due those are due March the 15th. Then you have a C Corp. Those are normally large corporations that normally form those, and those are taxed at a flat higher rate tax, which is not a pass-through entity at all. And those are due April the 15th.
Can you change, for instance, from a sole proprietorship to a partnership?
Yes, you can. In order to change the entity, actually, there's just forms that you have to fill out, which is one form is an 8832 and then a 2553 form. Those forms have to be filled out and then sent into the Internal Revenue, basically to let them know that you want to change your entity, and kind of just a brief description on why you want to change the entity. And then at that point, they send you a letter confirmation, basically letting you know that you have your entity has been changed or viewed differently from their standpoint. And then it will give you a date of when that return has to be filed.
So who has to file, for instance, a business return as opposed to the Schedule C?
When you say who has to file, so meaning, I'm not sure I understand that question, but a Schedule C, again, can be set up. I would say, let's just say someone has started, I don't know, a photography business or something like that, and they're just kind of getting started. They really hadn't gotten, a lot of clientele and things like that. So that's one of the quickest ways to form a business, which is basically just doing the LLC and then just doing your tax return on a Schedule C, which is just right there on the personal return. I'm not sure if that's what you were asking or if I answered that question to what you asked.
Are there any like income? So let's say, that same example, that person who is the photographer, let's say, the first time around they might make, I don't know, $3,000 their first year, but, they do phenomenal the second year and go up to 50,000. Is there like an income amount that would kind of signal a person of whether or not they need to transfer from a LLC to like an S Corp or another type of entity?
So I will say, well, from a legal standpoint, no. Like from the Internal Revenue standpoint, no, they're not going to say, oh, okay, you make, $500,000, you now need to come off of a Schedule C, a sole proprietor, move over. But from a tax standpoint, if you have a good tax preparer or a CPA or anybody who's doing your taxes, that's probably one of the things that they're going to highly recommend for so many different reasons. If your business has stepped up the game that high, one, you want to reduce those self-employment taxes. Two, you actually want to start separating yourself from the business, from the personal side. So a lot of people say, oh, the LLC protects me. Well, it does protect you, but also if something happens within the business and someone wants to try to sue you, there are ways around that LLC. And then if they say, oh, okay, well, we need to see the business tax returns, now you actually have to give them your personal tax return because that's what the Schedule C is filed on. So now they have pretty much access and to see all of your assets or anything that is filed on that personal return, as opposed to being a C corporation or S corporation or a partnership. And you say, oh, let me have your business returns, you know what I mean? And just kind of what they're looking at and going after, that's exactly what you give them, because now they don't actually see your personal return. So no matter what, when I start seeing a client really start to really make money, I like to talk about those options, unless we put some really serious things down in place. But 9 times out of 10, I'm going to suggest to move that over to a different entity. And the reason I say when a lot of people start off pretty quickly with an LLC, it is easy to form. It's very easy. Again, it's just on a Schedule C. And sometimes people get involved and the business really doesn't take off, or it's not really what they really wanted to do. And now you don't want to go through the hassle of creating these corporations and all this kind of stuff if nothing really pans out of it.
Thank you. You've definitely answered that. Thank you so much.
Yes.
So I know you said that you do bookkeeping, but if someone's just starting off and they're trying to maybe save a few bucks on the front end, do you have any apps that you would recommend so that they could maybe keep their books themselves and then just share that with you?
Yeah. I don't really necessarily have a lot of apps. So I would say, one, Excel spreadsheets, if you're pretty savvy with Excel, can work very well. I have people use Excel. What I do just kind of throw out there to a lot of my clients is QuickBooks. QuickBooks is very easy, it's self-explanatory, and you can get like the cheapest, the lowest, I think is simple start or whatever. I'm not even sure what they call it now. And that's just something basically that QuickBooks I think is good. You can link it to your bank account and all your business transactions. So of course, if you start a business, you should definitely have a business bank account and use that solely for the business. Like, don't commingle the funds, don't do personal stuff out of it. Don't do any of that. If you need some money or something, just transfer the money from the business side just to the personal, and then try to, use your personal things. But QuickBooks will link to the business. The business bank account and QuickBooks can link to one another. So therefore, all your transactions, your income and everything are dumped right into QuickBooks. And then it's just a matter of reconciliation. And that's pretty, easy and simple, self-explanatory.
You mentioned the word commingling. So that is when you use business funds for personal things and personal account for business items?
That's correct. So like, a lot of people think, oh, well, I use my car, and so I pay my car payment out of my business account. Well, unless the business has purchased the car, technically, you're not supposed to be making that car payment from out of that business account. That's just your personal car, and you should be paying for it out of your personal account. And they're like, well, I use it for my business. But if the business didn't purchase it and you actually got audited, they could actually disallow it. And especially if you only have one car, because they know that you're going to be using it for personal use as well. So to get like 100% write-offs, I always tell people, if you have one car, then you can purchase another car or something, or lease something in the business name. So yeah, those are that's what they consider like commingling funds. You basically just trying to write off personal things out of the business account. Now, there are times where, let's just say, I don't know, you're out and for the business, you need to purchase something, and I don't know, for whatever reason, you don't have your business card with you, and you have to purchase this from Best Buy, and it's $500 or something. You can use your personal account to do that. And then what you do from there is you just actually take that and expense it to the business. So you, the owner, will expense it to the business, and the business will cut you a check.
That makes sense. I think it's like new agents or new business owners. I find that a lot of people don't have business credit. So sometimes for larger ticket items that they want to purchase for the business, they do use their personal card. But that is great information. Thank you.
Yeah, you can do that. Just make sure you have a receipt, and just do it like you would if you actually work for an actual employer who says, hey, Antoinette, you purchased this and I need you, Antoinette says, I want you, the company reimburse me. You give the company the receipt, with an expense voucher, and they reimburse you.
I have a quick question. So what happens if you don't reimburse yourself from the business account, but you still have like all your receipts and things for when, tax time comes?
You can still put the expense in QuickBooks or whatever you're using. You can still put it in there. And then when the company does earn that money, then you can just pay yourself out that way.
Okay.
And so if you don't have QuickBooks, or even if you do or whatever, you just make sure you have a way to record it as a running tally, because you still want to capture that deduction during that particular tax year. So let's just say, in 2021, you bought something for $1,000, but the company hasn't made enough money really to afford to be able to give you that $1,000 back. You can still expense it for that 2020. And then in 2022, when the company starts to make money, you can pay yourself $1,000, or you can pay yourself, $500 or whatever, but you just keep tally of it.
Gotcha.
And or from a side, you can actually loan the company. So again, that's really just kind of a due from, or company, loan. So, hey, I'm going to loan my company $5,000 as a startup cost. And that's going to be sitting basically on a balance sheet. And then, when the company starts to make money, then the company can gradually pay you back out.
Okay. Thank you.
That is great to know. Thank you.
Yes, ma'am.
So
if we are,
question, Annette, help me if I'm not phrasing it correctly, but this question speaks to, or could you speak to, how owning, and I'm going to say a home, helps with your taxes, or could help with your taxes?
that's right, tax benefits of owning a home.
Thank you.
Sure. So owning your own home, one, definitely you get to write off the interest and the property taxes. So from a personal standpoint, now you have a tax return, and you didn't have a home. Let's just say you didn't have a home, and you file your taxes, and now you don't have enough to itemize. Once you start to own a home, now you can possibly itemize, which gives you larger deductions on your tax return to help reduce your tax liability. So now at this point, excuse me, at this point, you may have, you have your interest, mortgage interest at the end of the year, and the property taxes that go onto the Schedule A that help reduce it. And if you own your own business and you even work out of home, primarily that allows you to write off a certain percentage. On a Schedule C, it's done what they call an 8829 form. So basically it just takes a portion of your business, a portion of what you're using for the business, and allocate it against the whole house. And then you get to write off all these things, but it's only going to give you a portion of what you use, because they also know you're using a home for your personal business. Now, if you are like a C Corp or S Corporation and you're writing and you're working from home, the best technique that I've found that keeps you from having to claim the income is basically the employee, expense your employer for the expenses that occurred for using your home. So some people, what they used to do was the owner, the employee. So say, for instance, like me, if I would turn around and I'm gonna say, oh, okay, I'm gonna rent this office space, this room here out to my business, and my business is going to pay me $1,000 a month to rent this off. So now that's $1,000 deduction from the business side, which is cool. But then I got to turn around and claim that $12,000 that I've earned as income on a Schedule E. And then from that standpoint, you really don't have a whole lot to write off. It's just a little bit, maybe a certain percentage. And I am apologizing. My little poodle has just come over here. So what I found that works very well is the fact that if you expense yourself, so let's just say you allocate it, you find out exactly what the percentage is for using your lights, your internet, and all those kind of things. So now let's just say that expense come up to, I don't know, $200 a month. So now what you do is you expense that to the business, basically for allowing the business to use a portion of your home. That's now not considered income. It's just basically a reimbursement, if that makes sense.
Yes.
Okay.
I think so.
That's the way around not having to claim income. That's the way again around not having to claim the income.
Thank you for that.
Sure.
I just had a quick question. If someone would like to work with you, I just want to confirm that the best way, it sounds like, for them to kind of keep track of what they're doing is through QuickBooks. And I know that you can like send spreadsheets and all that stuff, or do you use a different process as far as bookkeeping?
So I actually use QuickBooks. So a lot of my clients, what they do is they purchase either QuickBooks themselves or they come through me to purchase it. And no matter how it's purchased, you can still give access. So whether you purchase it on your own or whether you purchase through me, you and I both still have access to it. So I'm the accountant that has the access, and then you are the customer that has the access.
Awesome.
Anyone who uses spreadsheet or, Excel spreadsheet, basically they just keep the spreadsheets themselves. And then at the end of the year, they just may send me, the full spreadsheet with the calculations already written out, or lined up. Basically, this is the total income. Like they have developed, a tab for each month, and then they have a tab that has all the totals. And then the totals is basically going to show how much money was earned and what the expenses were, basically a line item. And then I have a net at the bottom.
Okay, thank you.
Mm-hmm.
How about if someone had several children, like they wanted to pay as an employee business?
Yes. So that can be done. So what I like definitely talk about is, one, make sure the business is making money that you can afford to pay the children, and to make sure the children are of reasonable age or have reasonable duties that would make sense, that will align with the payout. Okay. Years ago, I've had people, oh, I heard I could write my kids off, but I'm going to write my kids off. I'm going to pay them, up to $12,000. And then you're like, okay, but the kid's 5 years old. You know what I mean? Like, how do you really justify paying someone $12,000 for the year? And what is a 5-year-old really doing? So let's give a good example here. I have my kids on payroll. My kids are now, 18 and 15, but they've been on payroll now for going on 2 years. So basically started at 13 and 15. And so I do pay them up to the $12,000 max. I think it's $12,200. They don't have to pay, as long as they stay up under the $12,200. They don't have to pay self-employment tax or with any withholding taxes. So therefore, with that being said, they don't have to file taxes. So now I have a $24,000 deduction from the business side, and I've still filtered $24,000 into my home and don't have to pay taxes on it. So it's a very good method. Can be used. You just want to make sure that it's reasonable. You know what I mean? That it makes sense, so that we don't get caught up. As I gave the example, someone 5 years old making $12,000 again, what can they do at 5 years old? And, a kid could be 9 years old and you could pay them, I don't know, let's just say $3,000 for the year. But that could be, okay, you know what? I meet with clients here and I've given that responsibility of my child to make sure that the office is clean, the bathroom that the customer is going to use when they come in, if they have to. Like my home here, I have a 3-level townhouse, but my first level, when you first walk in, is my office, and there's a bathroom right here. So this whole space area can be considered my introduction to the office, and I have to keep this whole area clean in order for my clients to come by and, sit. And so therefore that's a reasonable, write-off, or reasonable justification, I can say. Or if you have filing, it depends on whatever kind of business you have, you know what I mean? You may have some filing, you may have some copies, you may have whatever, but as long as if anything ever comes down the pipe, as long as you can be able to explain what that duty is for that child who's getting paid this income.
That's definitely good to know. I put my niece to work and didn't realize that I could write that off.
Now let's make sure we understand, but that's only through payroll. Okay.
Right.
Meaning the actual payroll. Yes.
Yeah.
Because some people want to do it as a 1099. Now keep in mind, if you're not going to do it through a payroll and they get paid anything over $600, that has to be reported if you want to turn around and pay that, put that on your taxes as a deduction.
Gotcha. Okay.
What about realtors and their uniforms, for instance, or like if they buy certain clothes, could those be written off?
So, and if you are your real estate, and so you have a shirt, logos and stuff that you bought, shirts you had made up with your logos and things like that on, and that's what you wear to show homes or whatever the case may be, those things can be written off. But just an everyday dress attire, that is not a business write-off. They look at that just like if you were going to corporate America, just like you go into an office and you got to buy suits to come there to work. They're not going to pay you for having to go out and buy a suit just to come to work. So only if it's uniform type required, things like police officers, they have to buy those particular uniforms. Again, if you have your own business, like, here, I bought some shirts and I have my logo on them. So now let's just say they were, I don't know, or if I bought suit jackets and my suit jacket had my name on the jacket or any type of platform like that. And now I have to get them dry clean. You know what I mean? Now I can write those kind of things off because I got to get a dry clean and whatever, but that's an actual uniform that my company now has to represent and wear. But just an everyday, t-shirts and things like that.
Okay, so specialty events, you get a t-shirt made for an expo, all that good stuff that is able to be written off.
That's able to be written off. Or let's just say you bought t-shirts and that's what you want to wear as your attire when you meet clients. You know what I mean? It doesn't have to be a special event, but you just want to, like, I bought some long sleeve shirts just for me because when I would meet with clients, when I come back up to Maryland, I would meet with them. I didn't want to dress up every day, but I wanted to still be representing myself in the business in a professional way. So I've just bought nice long sleeve shirts. And so of course I can write those off. And if I chose to put those in the cleaners, then I could, and I could still write that off because again, it's business attire that I've chosen, that if you're working for the business, you have to wear this attire. So I don't want you to think it just has to be special event.
Thank you.
Mm-hmm.
I think we've covered a lot, a small amount of time. I do, you just have any general tips for someone that is self-employed, or maybe like an independent contractor?
Well, what I would just say, definitely self-employed, independent contract and things like that, especially if you don't have a full-time job, just keep in mind that, taxes, you're now responsible for your own taxes. And there are so many different methods and things out there to help reduce that taxable income. So always, as I watch this commercial every morning on the local TV station, they always ask questions. And then at the end, they say, please consult your financial advisor. So I definitely say, for anyone whether you're actually self-employed or not, it's definitely makes sense to have a good financial advisor, someone that's going to help guide you down that right path of putting money aside and preparing all of us for the future. Because there's so many tools and things out there that can be used and done to help us generate wealth, and keep our money in our pockets and do things the right way. So that's basically what I said. Just always keep in mind, because I have some people that go out there and just make the money. And then when it's time to pay taxes on it, then they're kind of culture shock, like, oh my God, now I got to pay taxes on this. Well, it was, free money, and like it was tax free when you got it.
I do have a question about being audited.
Mm-hmm.
Is that just random, or are there like things that the IRS like looks for, and how long should you keep your receipts for things that you've written off and stuff like that from your taxes?
So the minute that you start filing taxes, you can be prone to be audited. So people just need to understand that it can be just a general random pick. Now, there are certain things that sometimes that can trigger. And one of the things, definitely from a Schedule C standpoint, is someone who's claiming a bunch of losses and no income. So if you have someone who's claiming losses losses basically for like 4, 5, 6 years straight with no income or very little income, then that's a red flag, especially if the losses are, $2, $3, especially $5, $6, $7,000, pretty high. And so the Internal Revenue does look at the fact that 3 out of those 5 years have to generate income and not a loss, has to generate a profit and not a loss. Because if not, then they'll think that that's basically just a hobby. Most of the times with the pass-through entities, get away with it a little bit more than you can with something that's on a Schedule C. Because if it's Schedule C's, for years, people will develop those basically just to have a loss. Like when I first moved here in this area, I remember just kind of standing talking to this guy, and he was like, yeah, he cooks and he sells food. And he was like, yeah, everybody was telling me I should really open up a business so that I can, use this as my write-off on my taxes, and so I can get me some money back and claim me a loss. And so I'm like, I'm kind of looking at him like, well, that's not the goal to go into a business, is it, to have a loss? And he's like, yeah, but it said it'll help me on my taxes. I was like, yeah, but who wants to do that? So again, they kind of caught on to certain things like that. So those are some things that can trigger, or be a red flag. I will say this too, and definitely when you start your business and things like that, if you don't have like the right dollar amounts for the deductions and things like that, definitely never just put down, like I have clients that'll give me their expenses and all of them can be in zero forms, like 2,700, 1,000, 1,900. Those are definitely triggers. You know what I mean? Like that algorithm, I think I'm saying it right, that all of that is being looked at, because they know at that point you have not taken the time to add up receipts or do anything like that. That's basically like you're just kind of guessing at what these expenses are. In terms of keeping receipt, they normally say around 7 years. I say anywhere between 7 and 10 years. One thing I will say about receipts, what I do for me is I scan a lot of my stuff in. So receipts that I have from somewhere, especially those ones that after a course of a time, the receipts fade out. I have a little small scanner. And so I scan all of that stuff into like a folder, and kind of label the receipts like that.
That's a good idea. I definitely lose receipts.
Yeah. And the reason why you have to like keep a kind of like receipts on certain things, because like one lady, she's a Mary Kay consultant. She's always buying food and or things like that for her, I guess her team. Mm-hmm. And so she's going to the grocery store a lot, and she's like, do I have to keep the receipts? And I'm like, yeah, in that case, you really kind of want to keep a receipt, even though it's on your business, on the statement, you know what I mean? Your bank statement to show it. That bank statement doesn't really break down what it really is. You know what I mean? So from that standpoint, things like that, you want to make sure you keep a receipt, label what it was for, and then scan it. Because if they just see it, they're going to just disallow it. I know I would. If I'm reconciling someone's account and I see all these groceries receipts, I'm not even going to think that it's for the business. I'm just going to be like, you just must be buying groceries for your house. And that's exactly how an auditor will look at that.
Okay. Do we have any other questions? I think that was it. All right. Jeanette,
all righty.
Close out, or Annette, do you want to close out? I know we usually close out.
Well, we're definitely going to, I guess, well, I don't know how to say this, and maybe you have to cut this out, but I think that we want to have Cassandra's contact information so that we can, or post that somehow so that people can really reach out, because there was a lot of, clearly she's an expert on the matter, and we can't remember all that information. And I don't know, if we're trying to grow our business, we probably want to leave a lot of things in the hands of an expert. And I think for me personally, one of the things that I think resounds with me the most and was one of the things that made me say I really want to sign on with her was when she talked about, we were having the conversation. I was kind of like the man that she was saying. It was like, yeah, I just really am looking for someone to help with my taxes because I need to write off everything because I just don't want to pay any taxes. And then she was like, well, that doesn't make that doesn't really make a lot of sense. Like, you're trying to grow a business. So you definitely, and what I'm finding is that, you know, when you want to apply for loans, when you want people to invest in your business, you need to be able to show a profit. So with everything, I'm a true believer in balance and alignment. And I think that writing off things that should be written off is absolutely appropriate, but also acknowledging your profits goes a long way in growing your business. So having an expert like Cassandra to be able to help you navigate these waters is really, really a benefit to your business.
That's good that you pointed that out too, Tonette. I will say, I'm in the process of buying another house and being you guys in real estate. So with me buying another home, that was one of the first things they asked. Oh, does your business have a loss? And I'm like, no, my business actually has never carried a loss. And they're like, oh, that's really good. You know what I mean? Because they only go back like, what y'all know, 2 or 3 years, 3 at the most. But the mere fact that they knew my business has never carried a loss. I might bring it down, but I've never had carry a loss. So that can go a long ways, especially if you're trying to do like loans, business loans and things like that. You know, the purpose of getting into business, of course, is to make money. And we can find other ways to, you know, I just think it's just been a stereotype, I guess I would say, for having a clean conversation about it in terms of having losses, you know, just so that we can get a large refund. And I'll say this, you know, the cliche is, if you're getting big refunds, then you're not doing something right. If people can really understand that saying. Yeah.
My grandfather did taxes for years, and he used to say, you know, if you're getting a refund, you're giving the government a tax-free loan, and ask me, would you think they would do that for you? So I quickly, you know, made it so that either I owed a very low amount, or, you know, but I kept as much money as possible, of course.
Exactly. Yes.
Okay, well, I know your dog's in the background. It's okay.
I locked them in the door. I'm sorry.
It's okay. We just want to thank you, Cassandra, for joining us for Tax Talk. It was very beneficial. I definitely learned a lot. I learned some things that I should have put on my taxes prior to April 18th, but going forward, I will be ready. And I thank you, Tonette thanks you, and Annette thanks you for joining us. And we will put your information at the end of this video.
Sure. Tonette, you can have the website, correct?
I'll definitely make sure that I do.
Yes, it's camtaxllc.com. And that's CAMTAXLLC.com.
Okay. Okay, now you can go tend to the dog. We appreciate you. Thank you so much.
Thank you so much. We appreciate it.
I appreciate you guys. Have a great day.
You too.
You too.
Bye-bye.